It relies entirely on the market as a return stream to generate the return profile that you've seen in both the bull and bear market here. So what is that market return stream that I'm talking about? In the context of our baseball analogy here, that is an undiversifiable risk. That is our pitch. In other words, we have these factor models that are trying to explain stock returns in the cross section. Whether or not they're priced, you can do your Fama-Macbeth regressions, you can do your time series regressions, whatever. These models fail to predict returns. In other words, right, if I'm stepping up to the plate and I know that pitcher likes to throw fastballs, I can expect a fastball all I want. It doesn't mean he's going to throw one. Could be a curveball, could be a slider. These models aren't going to predict anything. They're going to be able to explain the returns, explain why I hit a base hit, a double, a triple, or knocked it out of the park, but it's not going to forecast what's to come. The academic literature documents plenty of risk premia. Some are dried up, some have been underperforming for decades. We have the market risk premium, the most well-known one of all of them. That's just simple US equities exposure, simple US market exposure, for example. Variance risk premium, the idea that downside risk portfolio insurance is systematically overpriced. Hedge funds exist just to harvest that inefficiency. It's simple in design. It's just selling insurance, but it's hard to execute. Small minus big, high minus low, momentum. There are plenty of other undiversifiable risks, plenty of other risk premiums that you could expose yourself to. These are return streams that your strategy can expose itself to. Let me give you an example of two completely separate return streams. Here's the original market return stream, and here is a systematic risk factor, social sentiment. If we run this, we can see that the correlation between the two is roughly zero. They have nothing to do with one another. When the market is in a bull cycle, sentiment doesn't care. If the market is to enter a bear cycle, what's going to happen? Sentiment is also not going to care. They're completely uncorrelated with one another. You can see that based on the regression on the right. This is because they're completely different pitches. They're completely different pictures. They have nothing to do with each other. All right? That is this idea of undiversifiable risk. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, Quant Guild has two crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.